If you are new to investing, the hardest part is not finding a stock ticker. The hardest part is knowing what game you're actually playing. Social media makes investing look like a race to find the next big winner. But most beginners need something much more important first, a simple strategy they can actually stick with. This is Market Ghost, stock market strategy without the hype. In this video, we are building a beginner investing framework from the ground up. We are going to cover what investing really is, why risk matters, how ETFs work, how dollar-cost averaging helps, how to think about a beginner portfolio, and what rules you need before you buy anything. This is not a stock pick video. I am not telling you what to buy. The goal is to give you a clear structure so you stop reacting to every red day, every headline, and every random ticker that starts trending online. Educational content only, not personalized financial advice. Always do your own research. Most beginners think investing starts with the question, what should I buy? But that question comes too early. The better first question is, what is my strategy? Investing is not just predicting which stock goes up next. A real strategy includes your time horizon, your risk tolerance, your cash needs, your buying rules, your selling rules, and your plan for market drops. Without those pieces, you're not really investing with a system, you are reacting. Think about it this way. If you buy a stock because someone online says it is going to explode, what happens when it drops? Do you buy more? Do you sell? Do you wait? If you do not already know the answer, your emotions will decide for you. Market Ghost rule: do not start with the ticker, start with the plan.
Your time horizon is one of the most important parts of investing. It simply means how long your money can stay invested before you might need it. Money you might need soon should not be treated the same as money you can leave invested for years. If rent, bills, emergency savings, or short-term goals depend on that money, putting it into volatile assets can create pressure at the worst possible time. Longer time horizons can give an investor more room to ride through market volatility. Shorter time horizons usually require more caution. That does not mean long-term investing is risk-free. It means the strategy has to match the timeline. Before buying anything, ask, when might I need this money? If the answer is soon, your first priority may not be chasing returns. It may be protecting flexibility.
Most people think risk means the price drops. That is one kind of risk, but it is not the only one. Risk can mean owning something you do not understand. Risk can mean putting too much money into one company. Risk can mean needing cash during a market downturn. Risk can mean following a trend without knowing why it is trending. Risk can also mean having no exit plan and then panic selling when the chart turns red. A beginner-friendly strategy should reduce risks you do not need to take. That might mean diversifying. It might mean using smaller position sizes. It might mean avoiding complicated investments until you understand the basics. And it definitely means not building your entire plan around hype. Market Ghost rule: if you cannot explain the risk, slow down. One reason many beginners start with ETFs is because they can provide diversification in a simple package. An ETF, or exchange-traded fund, is a fund that trades on an exchange like a stock. Instead of buying one company, an ETF can hold a basket of many companies or assets. Some ETFs track broad indexes. Some focus on sectors. Some focus on bonds, dividends, commodities, or specific investing themes. The key idea is this: one individual stock depends heavily on one company. A broad ETF spreads exposure across many holdings. That does not make ETFs risk-free, And not every ETF is safe or simple. But a broad, diversified ETF can reduce single company risk. If you are new, do not just ask whether an ETF is popular. Ask what it holds, how concentrated it is, what strategy it follows, and whether it matches your time horizon. Stock picking can be exciting. It can also be stressful because individual companies can move sharply based on earnings, management decisions, competition, regulation, interest rates, or market sentiment. That is why many investors separate their portfolio into a core and optional satellite positions. The core is the foundation. It might be built around diversified funds that match the investor's long-term plan. Satellite positions are smaller individual ideas or focused themes that carry more specific risk. This structure helps prevent a common beginner mistake, turning a portfolio into a random collection of tickers. A portfolio should not feel like a junk drawer. Every position should have a job. Market ghost rule: build the foundation before adding the exciting stuff. Dollar cost averaging means investing a set amount on a schedule instead of trying to guess the perfect entry point. The reason this appeals to beginners is simple. Timing the market is emotionally difficult. When prices are rising, people feel late. When prices are falling, people feel scared. So they wait, then chase, then panic, then repeat. Dollar cost averaging does not guarantee profits. It does not remove risk, but it can create consistency. Sometimes you buy at higher prices. Sometimes you buy at lower prices. The goal is to reduce the pressure of making every entry perfect. For long-term investors, a repeatable process can be more useful than constantly trying to outsmart the next short-term move.
Some people online act like every dollar must be invested all the time. But cash has a job. Cash can protect your emergency fund. It can cover short-term needs. It can reduce stress during volatility. It can also give you flexibility when opportunities appear. The downside is that cash may not grow like invested assets over the long run, and inflation can reduce purchasing power, but that does not mean cash is useless. A smart plan separates emergency money, short-term money, and long-term investing money. Mixing those together can create problems. If your emergency fund is in the market and the market drops right when you need cash, you may be forced to sell at a bad time. Market ghost rule: cash is not always laziness. Sometimes it is risk management.
Before you buy anything, create rules. Simple rules are better than emotional guesses. A beginner buying checklist might include: do I understand what this investment is? Does it match my time horizon? How much can I afford to risk? Is this part of my core, or is it a smaller satellite idea? What would make me add more? What would make me stop buying? If it is an individual stock, ask how the company makes money, what could go wrong, and why you believe the current price makes sense. If it is an ETF, ask what it holds, how diversified it is, and what role it plays in the portfolio. The purpose of buying rules is not to make you perfect. It is to stop random decisions from controlling your money.
Selling is often harder than buying. Buying feels exciting. Selling feels like admitting something, even when it is just portfolio management. There are several reasonable reasons to sell. The original thesis may have changed. The position may have become too large for your risk level. You may need the cash for a real-life priority, or you may find a better use for the money. What you want to avoid is selling only because you are stressed, bored, or influenced by a loud headline. That is why selling rules should exist before the emotion shows up. Market ghost rule: selling is not failure. Selling is part of the strategy.
Here are common beginner mistakes to avoid. Mistake 1. Buying something only because it is trending. If the only reason you own it is because everyone is talking about it, you may not have a strategy. Mistake 2. Putting too much money into one idea. Concentration can increase both upside and downside, and beginners often underestimate the downside. Mistake 3. Checking the portfolio too often. If every small move changes your mood, your position size or risk level may be too high. Mistake 4. Confusing a lower price with better value. A falling price can be opportunity, but it can also signal real problems. Mistake 5. Having no plan for market drops. Red days are part of the market. Your plan has to exist before they happen. Here is a simple framework to remember. First, protect your foundation. Build emergency savings and understand your cash needs before taking unnecessary market risk. Second, define your time horizon. Money needed soon should be handled differently from long-term investment money. Third, learn diversification. Understand the difference between owning one company and owning a basket of assets. Fourth, create buying and selling rules. Your rules do not have to be complex, but they should exist before you put money to work. Fifth, keep learning. Investing is not about one perfect video, one perfect stock, or one perfect entry. It is about improving your decision-making over time. If you take one thing from this video, take this: do not chase a portfolio. Build a process. This is Market Ghost, stock market strategy without the hype. Educational content only, not personalized financial advice. Always do your own research.